Mr. Baker, I'm assuming by you setting up that camera, it's time to do another video update?
Yes, it sure is.
Why don't you tell our viewers the basic information, and I'll be with you in just a minute.
Sure thing. Today's date is May 22nd, 2011, and we will be filming our newest video with Joe Terril, president of Terril & Company, where he will share his latest opinions on the global economy.
Okay, I appreciate it. Shanda, we will be in the other room finishing the video, and be right with you, Jesse. Thanks. So, in our last video, we talked about our concern at Terril & Company for inflation around the world beginning to increase, our worries that it may get out of control, and if in fact inflation begins to get out of control, it will kill the worldwide economic recovery. It also has the potential of leading us into a speculative situation where people begin to make irrational decisions predicated upon the fact that prices and inflation are going higher. So that's one of the reasons why we became negative, and I think it's borne out now by the economic statistics that we're beginning to see. China is concerned enough about inflation and its effect on their economy that they have raised bank reserve requirements again. In the United States, we seem to be in a state of denial. It's very frustrating being in charge of investing $500 million of other people's money to see Ben Bernanke as chairman of our Federal Reserve in this state of denial, acting like inflation doesn't exist. U.S. dollar inflation is taking its toll everywhere around the world. Just last week in the United States, we saw leading economic indicators negative for the first time in quite some time. We saw the Philadelphia Fed index of business activity in that area at a very low figure, much lower than what people anticipated. And we saw figures on housing that seem to be reversing themselves and now turning very anemic. This is to be expected, and this is what happens when the consumer is forced to spend all of their money on food and energy. It leaves them with no discretionary income to spend on other parts of the economy. And that's what's happening in the United States. It's also happening elsewhere in the world because the world deals so much in U.S. dollars, and it's what we refer to at Terril & Company as we're having dollar inflation around the world. So while this inflation is going on, and we are having this, it's what we refer to as cash inflation. The Federal Reserve Bank of the United States continues to put out ridiculous statistics saying inflation's running maybe at 2%, and they adjust the figures and they throw out food and energy and they look at core rates and they look at maybe labor inflation. All that isn't important. The only thing that is important is the consumer and what is it costing them in cash money to operate. And that figure is going up at a 7 to 8% annual rate and has been for the last 5 to 6 months. I don't care what core inflation is doing, because if the consumer has a discretionary income problem as they spend everything on gasoline, electricity, heating and cooling their homes, and most importantly the very severe food inflation we're seeing, it doesn't make any difference to a figure that the Federal Reserve Bank may put out. The consumer's tapped out, doesn't have the money. $4 a gallon gasoline is a threshold that seems to force the consumer to pull back And that's what's happening. So we continue here to be very careful, and we're watching to see around the world if the balance of the world can make some sense and talk some sense into the Federal Reserve Bank of the United States to stop with the dollar printing, stop with the deterioration of the U.S. dollar, and stop with the worldwide dollar inflation. It is only going to hurt the worldwide economy, and ultimately it will backfire on the Federal Reserve's goal. They would like to bring 9% unemployment down. It will not bring unemployment down. It will cause unemployment to go higher as the economy deteriorates, and certain sections of the economy would be forced to begin to lay people off again if they do not have spending in their area of the economy. So until we can see that the Fed is serious and they intend to actually take some action, you must continue to be negative now about the outlook for the economy in the United States and also the worldwide economy. So relating our outlook for inflation in the economy to the investment markets, let's run through a few sectors very quickly. On stocks, we are negative. We're not under the impression we're going to have a big crash like we did in the fall of '08, but we certainly think we could see a 10, maybe even a 15% pullback. Very interesting to Terril and Company that when March 31st quarterly reports were reported by business, many of the analyst presentations that were given by companies, we heard company after company talking about how their costs are going up and how they're having trouble controlling their cost. This is the same part of inflation that we're talking about that's been affecting the consumer, is also affecting business. Very difficult for business to make long-range plans, plan on hiring people and expanding when they do not know what their cost of production is going to be or their cost of operations, because they have no idea of how fast inflation is going to drive prices higher. So if we're past the 2 to 3 year period of lower cost helping corporations with their earnings, and higher earnings have helped stock prices, we just want to be very cautious in here with equities, because higher costs could have a negative effect where perhaps earnings do not come through, particularly if the economy slows down and maybe the revenue side of the income statement slows down while the expense side goes higher. Not good for corporate profits, obviously not good for equities. Bond prices speak for themselves. The only solution to get out of this problem is the Fed is going to have to increase interest rates. We need short-term interest rates to be 2 to 3%, longer-term interest rates as measured by a 10-year Treasury to be 5 to 6%, and a very strong Fed talking about the fact that they are not going to let inflation get a grip and begin to be felt throughout the economy. If we have that, it's very negative for bond prices. So with interest rates at 200-year lows, Terril and Company sees no merit in owning bonds. We're asked very frequently about commodities, and commodities have had a pretty good pullback since our last video cast because we have seen evidence of a worldwide economic slowdown. This is a much more difficult call, but we continue to be bullish on commodities. And I think you have to stay bullish on commodities until the Fed actually shows that they intend to get serious about inflation and actually raise interest rates. Every day that the Fed goes by continuing to deny inflation and continuing to print more money just builds more momentum that ultimately we will see inflation move higher. If inflation moves higher, if the Fed continues to deteriorate the value of a U.S. dollar, you'll see more and more worldwide action to move money into commodities as a store of value. So we think the recent pullback in commodity prices is probably temporary, and we'll monitor that because I believe gold prices will go higher unless the Fed makes that commitment. See no indication that the Fed intends to make the commitment. Therefore, we'll see higher grain prices, we'll see higher prices for most of the hard and soft commodities. So, Mr. Baker, let's stop here. We appreciate everyone for joining us. This is Joe Terril for Terril and Company. Thank you for watching, and we will at Terril and Company continue to monitor any indication that the Federal Reserve Bank of the United States intends to actually do the correct thing. If they do, we'll quickly change our outlook. If not, and the Fed continues on the course they're on right now, we will continue to be negative about the economy around the world and negative about investments, and try and structure our portfolios, which we have in the last 30 days, in a very defensive nature. Thanks for joining us.